We now turn to how majority-owned investments are treated on the income statement. So just like how it's treated on the balance sheet, the target's income statement will be consolidated into the acquirer's income statement. As a result, consolidated net income reflects income that belongs to both the acquirer as well as the unacquired non-controlling interest net income. Now, this creates a bit of a confusion because what it means is that consolidated net income captures all net income belonging not just to the common equity, not just to the business that is just acquired, let's say 80% of another business. So it's not just that net income plus the 80% of the investment's net income. It's the total net income that belongs to both businesses together. And to get from that total net income, to get to the net income to common shareholders, you actually have to subtract the income that belongs to the non-controlling interests. So the way to think about that is with the equation that says the consolidated net income minus non-controlling interest expense from the perspective of the common shareholder. It's an expense just like interest expense to get to the net income that belongs to the common shareholder. Now, the non-controlling interest expense is going to be defined as the net income of the investment times the percentage of the investment that wasn't acquired. Put another way, non-controlling interest expense reflects the share of consolidated net income that does not belong to common shareholders. In terms of the cash flow impact of this net income, as well as dividends and distributions from the investment, because the net income of the investment is consolidated, the cash flow statement captures the operational, financing, and investing inflows and outflows of the entire consolidated business, just as if the investment was wholly owned. The non-controlling interest expense that's recognized on the income statement is a non-cash expense, but since consolidated net income is the first line in the cash flow statement, no add back of non-controlling interest is actually necessary. So this is a nuance of how GAAP wants you to start the cash flow statement. It wants you to start with consolidated net income. Since that's before you subtract non-controlling interest expense, it doesn't matter that non-controlling interest expense is non-cash. You don't need to add it back the way you add back depreciation or the way you add back stock-based compensation or even equity and affiliates income. It's because it's before that impact already. The next item that does appear on the cash flow statement explicitly, though, are dividends/distributions. I use the terms interchangeably, to non-controlling interests. So distributions, or let's say dividends to non-controlling interests, are recognized as financing cash outflows in the cash from financing section, usually right next to distributions to common shareholders, which are common dividends. Okay, we now go through the effect of non-controlling interests and the consolidation method on the income statement. So here we have the acquirer's income statement. Notice also that the acquirer is issuing dividends to its shareholders, and then we have the target income statement lined up side by side. So what you're actually going to see reported on the financial statements once the acquirer acquires this target, you're not going to see the acquirer's income statement anymore. You're going to see a consolidated income statement, which captures acquire plus target revenue. And notice that even though in our exercise the acquirer has only acquired 80% of this target, the full revenue is being captured, the full expenses is being captured. Pre-tax income is therefore just the combination of both, 550. And cash taxes together are 192.5. Now, on a consolidated basis, we just simply lump the net incomes together, and at this point, it's pretty straightforward. It's going to be 357.5. Now, where it gets interesting is now to get to how much net income flows through to common shareholders. Remember, the common shareholders are the acquirer who now owns 80% of the target. We have to take out the portion of income from this consolidated entity that belongs to the target's remaining shareholders or non-controlling interest. And in order to calculate that, we have to recognize that the target has generated 97.5 million in net income, 20% of which is owned by non-controlling interest now. So that's the exercise. So 20% of 97.5, I believe roughly comes out to 19.5. And so this represents the expense that reduces consolidated reported net income down to net income to common shareholders. And that brings us to 338 in net income to common. And now we turn to the impact on the cash flow statement of these non-controlling interests. So notice that we start, under US GAAP, you actually start with consolidated net income. So this is the starting line, not the absolute bottom line of net income to common. So you actually start with consolidated net income of 357.5. And so as we talked about in the prior slide, you don't actually need to add back non-controlling interests, even though this is a non-cash expense. Since this number is pre that expense, there's no need to add it back. So this, given that we're looking at a cash flow statement where you generate cash revenues of $1,200 on a consolidated basis, cash expenses of $650, meaning pre-tax income of $550, and then you paid cash taxes of $192.5. What flows down is actually $357.5 of cash that goes into your pocket. So your cash from operations, in this very simplified example, that focuses solely on non-controlling interest, right now, cash from operations exactly equals your net income. Under cash from financing activities, though, two things are happening. The first is dividends to the parent is an outflow of 100. And then the one other thing to identify here is that dividends to non-controlling interests is going to be 4. And that's because we're making an explicit assumption that the acquirer will issue $4 million in dividends to non-controlling interests separately from the $100 million that it issues to common shareholders. So your net change in cash is now the 357.5 minus the 104 for a net total of 253.5. So this is a basic cash flow statement and income statement with non-controlling interests. And here we see it sort of identified a little bit more clearly. So the next step is to complete the balance sheet impact. So we're going to do that together as well. So just hit the pause button, give it a shot yourself, and when you're ready, we'll do it together. So now that we've completed the income statement and the cash flow statement, and we identified the opening balance sheet, this being the opening balance sheet, we can now complete the end of period balance sheet based on what's happened on the income statement and the cash flow statement. So we know that cash increased during the year by 253.5. So we're going to have an additional 253.5. So let's actually just look at impacts for now, and then we'll do the full calculations. So cash went up by 253.5 from 1.22 billion. And then non-controlling interests went up by 19.5, which is the non-controlling interest income. But here's where we want to reflect that 4 million of the non-controlling interest income was actually distributed back to the non-controlling interests in the form of dividends. So the net impact is actually a plus 15.5. And then equity went up by 338 minus 100 in common dividends. So 130, or I should say 238. So these were the debits and credits associated with this. So if we add them up, if we add all the credits, 238 plus 15.5. So let's see, credits. We'll start with the credits first. 238 plus 15.5 equals 253. 3.5, which exactly equals the debits from cash. So our model's in balance. And then if we turn to the next slide, we see that exactly being reflected here, where you see that the differences are those 253.5s that we talked about. 253.5 equals this, and then plus a net 15.5 equals 35.5, plus the difference here, 238 equals this.